Healthcare REITs are very popular these days because of three key reasons. Firstly, they're offering very high dividend yields, often in the 6 to 8% range, and that's very attractive in today's market environment. They are able to offer such high dividend yields because the cap rates are relatively high for skilled nursing facilities, medical office buildings, and hospitals. The second reason is their steady growth. The population is today aging rapidly, with the segment of the population that's over 80 years old growing by over 5% per year on average. This is leading to rapidly growing demand for healthcare properties, right as their new supply is also falling off due to the high construction cost and high interest rates. It's resulting in growing occupancy rates and higher rents. And then the third reason is their recession resilience. The demand for healthcare properties is mostly a function of demographics rather than economics. People keep aging whether the economy is booming or struggling, and a recession won't stop people from seeking healthcare services. This is our most basic necessity, and the government and insurance are there to help us. So this is a relatively attractive space today, and we are ourselves heavily investing in healthcare properties via REITs at high-yield landlord. But not all healthcare REITs are created equal, and in today's video I want to highlight one popular healthcare REIT that I would avoid and one better alternative that's today overlooked by most investors, likely because it just recently had its listing. The popular REIT to avoid is Omega Healthcare Investors, ticker symbol OHI, and the superior overlooked REIT to buy is Sila Realty Trust, ticker symbol SILA. Both are seemingly cheap and offering very high dividend yields. I'll put a table on the screen comparing the dividend yields of both companies, and just based on a quick comparison, many individual investors may seem to think that Omega is cheaper than Sila, given that it's offering a higher dividend yield. But in reality, this higher yield is simply the result of a higher payout ratio. Adjusted for that, Sila is actually quite a bit cheaper than Omega at the moment. But I think that it should be the opposite. Sila should trade at a premium relative to Omega because of three key reasons. The first reason is that it owns safer properties. Omega Healthcare focuses on skilled nursing facilities, which is one of the riskiest segments of the healthcare property market. The cap rates are particularly high at 8 to 12% in most cases, and that's because their tenants are on shaky grounds with very low rent coverage ratios, and lease defaults are a frequent event in this business. I'll put a chart on the screen comparing the cap rates of different segments of the healthcare property market, including skilled nursing facilities, hospitals, senior housing, medical office buildings, and so on, and you'll see clearly there that skilled nursing facilities have the highest cap rates, and that's because they are the riskiest. They earn the vast majority of their revenue from government programs which are subject to changes. As an example, in 2011, Medicare cut reimbursements by 11%, severely impacting many skilled nursing operators, and this led to many lease defaults. This would be fine if these businesses enjoyed high rent coverage ratios to provide margin of safety, but it's the opposite here. These properties are typically operated with very tight rent coverage ratios of just 1 to 1.5 times, leaving no room for error. Skilled nursing is also a less critical segment of the healthcare property market, with potential long-term headwinds from the development of new solutions such as at-home care or assisted living. In many cases, a visit to a skilled nursing facility is not a must, it's a luxury. For these reasons, Omega has had its fair share of missed rent payments over the years. You don't get to earn such high cap rates without taking high risk. In comparison, Sila focuses on safer segments of the healthcare property sector. It owns mainly medical office buildings, inpatient rehab centers, and surgical facilities. These properties typically sell at lower cap rates of 7 to 8%, and that's because they are safer. These properties are much more critical because you may care for an injury post-treatment at home, but you cannot perform the surgery yourself from your home. The rent coverage ratios for these properties are also a lot higher at about 5 times on average, leaving significant margin of safety even if your tenants go through harder times. I'll put a table on the screen comparing the average rent coverage ratios of Sila to those of Omega, and you'll see that it's day and night. Sila has much bigger margin of safety, and we think that this will lead to fewer lease delinquencies over time. The greater safety is worth a premium, but in this particular case, the market is rewarding Omega with a higher valuation, and this doesn't make sense from the perspective of the asset quality. Now, the second reason why Sila deserves a premium is that it also has a better balance sheet. We really like Sila's balance sheet because it has low leverage with a 22% loan to value and just a 3.5 times debt to EBITDA, which is even below its own target of 4 to 5 times. It also retains 30% of its cash flow to reinvest in growth organically. And finally, it has relatively long debt maturities with no major maturity before 2028. In comparison, Omega has quite a bit more leverage with a 42% loan to value, a 4.2 times debt to EBITDA, and it has a big debt maturity wall coming its way next year, and it retains relatively little cash flow to organically pay off debt with its 96% payout ratio. So very clearly Omega has a riskier balance sheet. I think it's still reasonably good. I'm not saying that it's at risk of default or anything like that, but its balance sheet is weaker than that of Sila, and this should be priced at a discount in the financial market. And then finally, the third reason why we think that Sila is undervalued relative to Omega here is that it also enjoys better long-term growth prospects. Both Sila and Omega enjoy roughly 2% annual rent escalations, and they lease their properties on a triple net basis, meaning that their tenants are responsible for all property expenses, including even the maintenance. However, as we noted earlier, we would expect fewer lease defaults and missed rent payments from Sila's tenants. The lower leakage should result in stronger organic growth. Another advantage of Sila is that it should be less impacted by the surge in interest rates, given that it has much lower debt and it has fewer debt maturities coming its way in the near term than Omega. Finally, Sila is in a great position to keep expanding its portfolio in the coming years by acquiring new properties because, for one, it retains a lot of cash flow, as we mentioned earlier, about 30% of it, and then secondly, its own leverage today is below its target, and so it can now take on new debt to buy new properties. This debt should have an interest rate about 5.5%, 6%, but it's buying properties at an 8% cap rate, so there's a nice positive spread that should lead to growth on an FFO per share basis. All in all, we think that Sila should be able to grow at over 5% per year going forward. We are much less confident about Omega. And so all in all, here you're getting better quality at a lower price, and therefore we think that Sila is set to outperform Omega going forward. It owns better assets, it has less leverage, fewer debt maturities, and superior growth prospects. We think that the market has simply missed this because Sila is a relatively new REIT, it's a brand new listing, most investors are not following it. Lately I've received many messages of investors being concerned that the company may have suspended dividend payment, but in reality it's simply that they switched from a monthly payment to a quarterly payment like most other public companies to save on administrative costs. And it's just a company that's poorly researched, there's not much analysts covering it, and so it's a great opportunity for more sophisticated investors like ourselves who follow this space very closely, and it's a great example in my opinion of how active investors manage to outperform in the REIT sector by just following this sector much closer than generalist REIT investors who make up the majority of this sector, unfortunately. Now let me know in the comment section below what other high-yielding REITs you're buying at the moment. And by the way, if you want to access my full REIT portfolio, you can join us at High Yield Landlord for a 2-week free trial. This will give you immediate access to my entire real money REIT portfolio, all my transactions in real time, my exclusive REIT CEO interviews, and much more, completely free for 14 days. You won't be charged anything in the first 14 days. You can come in, enjoy the research for a week. If it's not for you, just cancel. You won't be charged anything. Thank you very much for your interest. Don't forget to like and subscribe. See you at my next one. Bye-bye.